I'm really pleased to welcome Bob Litterman. Given that I'm a quant investor for 2.5 decades, I know him very well. And as many of you know, he has influenced our thinking about quantitative investing, equity investing, asset allocation very much over the past 2.5 or 3 decades. Most famous is his Black-Litterman model, which he published in 1990. And I was always looking for a second piece who tells us how to create the fuse. You know, this would be very, very nice. So he was 23 years with Goldman Sachs, leading positions in research, risk management, investment, and also, of course, asset allocation. He is a co-author of many books, and one is The Practice of Risk Management and Modern Investment Management, an Equilibrium Approach. And he has a PhD from the University of Minnesota, a Bachelor of Science and Human Biology in Stanford. I was surprised about this topic today. I thought he'd come to Germany and talk about asset allocation, risk premia, factor investing, or whatever else. But maybe given the recent developments in US politics, you decided to talk about climate risk. And we are very much looking forward to your talk on pricing of climate risk and the effect of portfolio construction. Rob, please.
So it's a pleasure to be here, and I have been actually thinking about and focused on climate risk for many years, since I retired from Goldman Sachs in 2009. I am an economist, and I have a background in risk management, and climate risk is indeed a very serious, I think, risk management problem. So let me start by just talking about some of the basics. And I must say, it's in some ways a little bit embarrassing for an American to come to a European audience and talk about something that is much more understood, I think, and recognized here than it is in my country. But nonetheless, this is a global problem, and it's a risk management problem. So what is the basic nature of the problem? Well, the future is uncertain, and we are creating emissions, and those emissions create risk of changes in the environment. The atmosphere's capacity to safely absorb emissions is unknown. There is tremendous uncertainty about that, but it is clearly limited. And I've highlighted here the word safely because, of course, the impacts of climate change are already showing up today, and they're already creating damages, heat waves, extreme weather events, acidification of the ocean, and so on. I'm not a climate scientist, and so I'm not going to spend a lot of time talking about the physics of what's going on, but suffice it to say that we're doing an experiment, an uncontrolled experiment, on a very complex system, and it has impacts already, and we know that this is just the beginning of what will be a long-term set of impacts. And so when I say safely, I don't mean that there won't be impacts. There are already impacts. We can project that there will be trillions of dollars of damages from climate change over the decades ahead. What I'm talking about is catastrophic risk, a permanent and significant lowering of the well-being of all future generations. My children, their children, and every generation after that, and yours as well. That's what I mean by safely. So there's some capacity of the atmosphere to absorb emissions where that won't happen, and there's some level where that will happen. And we won't know for a long time what that is. It may be too late, in fact. So that's the nature of this uncertainty. And that capacity, think of the atmosphere as a reservoir, and we're filling it up. We don't know what the capacity is. Whatever the remaining capacity is a scarce resource. And so it's a resource, we know how to allocate scarce resources, we price it. And so we need to price the remaining capacity in the atmosphere. Today, globally, we're not creating those appropriate incentives. There are incentives in Europe and a number of other, in fact, more and more venues around the world are creating incentives. This is inevitable. In my country, we do not have any incentives. And in many of the large countries around the world, there are not adequate incentives to reduce emissions. So the pragmatic solution is to price this risk, that is to create appropriate incentives to reduce emissions. So that's what I'm going to talk about. Now, financial risk management, where I spent most of my career, has a number of lessons that apply to the management of climate risk. So let's just talk about some of them. The first one is very simple and obvious, and that is that risk management requires that you consider worst-case scenarios. Okay, that's what risk management is all about. It's the most important thing when you are a risk manager, is that you think about the worst-case scenarios. Now, if a scientist gets up and talks about worst-case scenarios, they're often criticized for being alarmists. Now, if you're a risk manager, that's your job, okay? And the worst-case scenario with respect to climate risk is just horrible. It's a catastrophic, permanent decline in the welfare of human society, and all of nature, of course, as well. Second lesson from financial risk management that applies to climate is that a growing risk is an urgent problem. Time is not on your side. You know, when I was at Goldman Sachs, I served many different leaders of our firm, and if there was ever a risk management problem, it was always a priority. No one ever said, come back next week. And the reason is because when you're managing a risk, if you have enough time, you can solve the problem. A risk becomes a catastrophe when you run out of time. Okay? We used to have an expression, time compression. I've seen it many times in my career. I used to manage a quant equity fund in 2007 when all of a sudden the entire quant space tried to delever at once. Rather than having months to get out of positions, which we thought we would have, we had hours. So when you run out of time, that's when you have a problem. And the third thing, and this is perhaps very clear to those in the investment community, is that the purpose of risk management is not to minimize risk. The partners of Goldman Sachs didn't hire me to minimize risk. They wanted to take risk. They wanted to be paid for it appropriately. So the whole idea, and as investors, you know, the basic question is, are you getting paid appropriately for the risks that you take? And if you're not getting paid appropriately, if risks are mispriced, then you have an opportunity. And so that's what financial markets do. They look at the pricing of risks. And that is the essence of the climate problem today, is we are not pricing that risk appropriately. That's the bottom line. Time is a scarce resource. This is an urgent problem. Let me go back just for a minute to this slide. You might have noticed this rather dramatic picture. I didn't mention it. You might wonder, what is that all about? Actually, that is an auto accident, and I was there. It's something that happened to me about 2 years ago. I was driving into New York with my wife. It was pouring rain that day. We were going in to see a play, and we're going to have dinner with some friends. And, you know, the old cliche is true. I don't remember what was going on until my wife, all of a sudden, she said, "Oh my God, Bob, watch out." And it was the tone of her voice and the cadence that told me this was a very serious situation. And I looked up, and I focused, and I saw this truck coming at us on the freeway. I was in this picture on the far side, and the truck was coming at us on the near side, and it was bouncing out of control in a way I'd never seen before. It was a big 18-wheeler, and there was fire coming out of the wheel well of the passenger side. And I thought, oh my God. And I immediately hit the brakes and swerved off to my right, because I was thinking, you know, that's out of control. and a worst case scenario could be really bad. And I don't know what's going to happen. And I saw this, there's a concrete barrier there between the two sides of the freeway, but I just wasn't sure that the engineers who built that had a out-of-control 18-wheel truck in mind. And in fact, there were some things I didn't know. The truck had already smashed an Audi and killed the driver. And it had been way over on the far side and had now already crossed the median between the express lanes and the local lanes, and it wasn't coming straight down that freeway. It was actually coming straight at a point right in front of us. And over the next 5 seconds, and I remember this like a movie that I've seen a dozen times, that truck hit that barrier, rolled up over it, bounced over it, landed right in front of us, and burst into flames. And we wouldn't have been able to stop, but luckily we were able to slow down, and I was able to swerve around to the right and go by it. There was a debris field now right in front of us. I was concerned, we might get a flat tire. We didn't. I later saw that our car had been sprayed with oil from the front of that tanker, and the heat as we went by was the most striking thing. It was a fraction of a second, because we were probably going 15, 20 miles an hour when we went by, and it was just incredible. The driver actually was able to escape with very serious burns, but he was able to climb out through the front of the truck. Now, why do I tell you that story, which is seared into my memory? Others might not draw the same conclusion, but for me, this is just a parable about climate change. We are today, globally, at the point where my wife has said, "Oh my God, Bob, watch out." And the question is, are we going to ease on the brakes, or are we going to slam on the brakes? Because we don't know how much time we have. That's the implication of fundamental uncertainty. You don't ease on the brakes. You worry about the worst case scenario, and you hit the brakes hard. And that's why I'm here today, because that's what I did. And that's what we, as a society, have to do. And the brake, of course, is the incentive that we create to reduce emissions. It's the price of emissions. And globally, if you think about the price of emissions, there are today, depending on how you measure it, about $500 billion of subsidies to fossil fuel consumption and production. There's about 60 or 70 billion of subsidies for solar and wind. Now, if you talk to the IMF, they measure subsidies relative to their measure of the social cost of carbon, in which case, in other words, relative to where we should be pricing it, they measure $5.3 trillion of subsidies to fossil fuels, okay? We don't know how much time we have. We have to slam on the brakes. Now, I'm very confident that we will slam on the brakes, and I'll talk about that. But, okay, so the implication is we have to slam on the brakes right now. Now, how hard should we slam on the brakes? That's what economists call the social cost of carbon. Now, as financial economists, investors, you all know something about risk and pricing risk. And what you know is that there's two kinds of risks. There's insurable risks, things like homeowners insurance or car insurance. Those kinds of insurable risks, the cost, the price of that risk is an expected loss. And the reason it's an expected loss is because insurance companies can diversify away the risk. So you don't have to pay a risk premium. When you buy a car insurance, the price you pay has nothing to do with your risk aversion or the risk aversion of the company that's selling you the insurance. It has to do with an actuarially fair expected loss, plus perhaps a little bit of profit. But if the insurance company tries to build in too much profit, another company will come in and underprice it. So as you see in this picture, diversifiable risk is priced at the expected damage. I don't know if you can see that, okay? The price of climate risk today, given all those subsidies, is a negative number. In other words, governments are subsidizing the production of carbon emissions into the atmosphere. And where should climate risk be priced? Well, it's a non-diversifiable risk. It's a risk like equity risk. You can't insure it away. Someone has to hold that risk. And so what determines the appropriate price is, number one, how big that risk is, and that's something we try to measure, but we don't really know. And then how risk averse is society. So risk aversion, increasing risk aversion, and increasing actual risk and uncertainty both increase the appropriate price for climate risk. Now, one thing we do know about risk aversion is that it's incredibly high. You've probably all heard about the equity risk premium puzzle. Why is it that globally investors in equities have been paid a premium of something like 5% a year in every country, in every stock market around the world for as long as we have good data? It doesn't make sense. It's a puzzle for economists. Why are investors in their long-term decisions so risk averse? I don't have a good answer for that, but it applies to pricing climate risk. In other words, the same issue, how should we price this risk, implies a high price. And in terms of the actual risk, we've never run this experiment before. You know, if we had 1,000 worlds and we'd run this 1,000 times, we would have some idea what the distribution of outcomes might be. This is the first time we're doing this experiment. It's not something we can reverse easily. And so there's tremendous uncertainty. You know, economists sometimes make a distinction between risk and uncertainty. When the partners of Goldman Sachs decided in 1994 that they needed a risk manager, it's the first time we had a risk manager for the firm. It was a partnership, and the partners thought they were pretty good at managing their risk. But, you know, as we got more involved in markets and started doing more trading, they decided we need someone to quantify this risk, particularly across equities, bonds, currencies, all the different markets that we traded. We needed a common unit, and that's why they hired me to measure risk, called an evaluate risk. Luckily for me, the partners decided, yes, this person should have the title partner. They should be partner level. But they didn't, you know, and it didn't, I wasn't surprised. We all understood that what those other partners did is they managed uncertainty. What I did is I measured risk, okay? Managing uncertainty is what we have to do with respect to climate. And it's a much more difficult problem. It means you have to have a higher price, not a lower price, when you manage the uncertainty of climate risk. Now, we have models that we use to measure the appropriate price for emissions. These are called integrated assessment models. About 10 years ago, when I was thinking about retiring from Goldman, and one of my partners who had already retired said, "Bob, are you interested in the environment?" I said, well, I might be, I could be. My undergraduate major was human biology. I said, why do you ask? And he says, well, you know, he got me involved a little bit. And I thought, well, climate risk is a very interesting risk management problem. Let me read more about it. And so I started delving into the models that economists were using to price climate risk. And what I discovered is they were very inadequate. They actually didn't adequately take risk into account. What they were trying to do was to price the expected damage. That's not adequate. You have to think about worst case scenarios. And you have to think about how do we price bad outcomes. And so I got involved, and I've actually been working in this area. Now, what I discovered is there is tremendous uncertainty, not just risk, but uncertainty about where we need to price climate risk. We can't do experiments, et cetera. And so you can get numbers, the IPCC reports, you can get numbers anywhere from $2 a ton to several $100s a ton. And, you know, I'd say it's not really quite that uncertainty, but I've given you an idea here in this graph of, you know, what the appropriate price might be. I don't know if you can, there, between, you know, maybe $40. The U.S. government estimates $40 a ton is about the right number. I think of that as really a lower bound. And that's because, by the way, the integrated assessment models that the U.S. government relied on do not take risk into account adequately. And the upper bound might be something around 150. Now, some people think higher. As an economist, I'm very impressed with the power of markets and of incentives. You know, sometimes people say, Bob, you're an economist, you think people are rational. I say, no, I don't think people are rational. But, you know, I understand what people are. I studied human biology. My dog, Bitsy, she doesn't understand rational behavior, but she responds to incentives. You know what I'm saying? We all respond to incentives. That's just, everyone responds to incentives. That's a tautology, by the way. That's what an incentive is. It's a thing that we respond to. Okay, so the question is, I think if we price, or the point I'm trying to make is, if we price if we price emissions at $150 a ton, or probably $100 a ton, there will be a very rapid transition to a low-carbon economy, very rapid. And in fact, most scientists think that we will probably have to pull carbon dioxide out of the atmosphere. We'll also probably have to throw stuff up into the stratosphere to cool off the Earth, geoengineering. It's going to be an all-hands-on deck over the next several decades to try and avoid all of the problems that we're creating today. And I'm sure we will do that, and I hope and I'm confident that we will be successful. But it means that we have to have a price trajectory that looks something like this, maybe goes up a little and then eventually comes down. It comes down because of technological change. It's going to be cheaper in the future to address this problem than it is today. But the sooner we get started, the better. There's a deadweight cost of delay. And by the way, when you try and measure what that deadweight cost of delay is, it's huge. It is absolutely the most insane thing we can do not to price climate risk today, because whatever that remaining capacity is, we're wasting it. Okay? And that's a deadweight loss. We can't get that back. It means the price of addressing this problem is going to be higher forever because of what we're doing today, because of our lack of action. So how hard should we brake? Well, that's what engineers call a dynamic optimal control problem. And it's an optimal control problem with tremendous uncertainty. We don't really understand the state very well. We don't know how quickly economies will respond. We don't know how behavior will change when we price emissions. We don't know how the technology will develop. We certainly don't know how fragile the environment is. There's tremendous uncertainty. And so we have to take all of that into account. And what that means is this is not an ease on the brakes scenario. This is a slam on the brakes scenario. You know, the difference is easy to understand if you think about it. If you knew with certainty what's required and you knew how much time you had, you could ease on the brakes. But we just don't know. And so you have to plan for that worst case scenario. Now, what does that mean for asset owners? First of all, it means you better be prepared for a slam on the brakes scenario. It's coming. The longer we wait, the harder we have to slam on the brakes when we do. Now, I would say we're in the middle of a transition to a low-carbon economy. You see it all around the world, despite what's going on in the U.S. And obviously, there are tremendous frictions that have prevented appropriate action to this point. I don't really want to talk about all those frictions, but you know many of them. There are companies today whose profits depend on producing fossil fuels. They are a very strong lobby. There are, you know, the beneficiaries of taking action live in the future. They're not here today voting. Okay, so those are some. We don't have an appropriate global governance structure. The UN is very weak. It's been trying to address this problem. And you know, it's so there's many problems that have created these frictions, but at some point they're going to break, and then there's going to be a rapid transition. Okay, so what should asset owners do? Well, a number of options have been suggested. Divestment is one. Another one is, I'll talk about hedging stranded assets. I'll talk about what they are and why we might want to think about that. That's kind of my preferred solution. and engagement as owners of companies. I think owners have a very important role to play, and I'll talk about that as well. So first, why not divestment? There's a lot of environmentalists and others who say you should just divest of fossil fuel companies. And it's usually a moral argument. This is, these are bad companies. I'm not a moralist, so I'm not going to make that argument. But there are practical issues as well. Where do you draw the line? I just flew over here. Was that immoral? Because that used fossil fuels. Many of you drive fossil fuel cars. Is that immoral? What about utilities that burn fossil fuels? I don't think using fossil fuels is immoral. I think what we have to recognize is that there's going to be a transition. Today, we don't have appropriate incentives. Let people make their own decisions when we have appropriate incentives in place. Okay? So I'm not a big fan of divestment. However, before moving on, I just want to mention there are some incredibly bad actors out there. And I'm going to focus on ExxonMobil for a minute. As you know, Exxon, I hope you know, has been funding the deniers and those who deny the reality of climate change for decades, despite the fact that the scientists at ExxonMobil knew about this 30 years ago. Exxon, in its own behavior, took account of climate change 30 years ago, okay? But at the same time, for their own selfish reasons, they funded people who were intentionally promoting disinformation about this. And that has really screwed up the political system in the US. Today, you have very polarized people on both sides of this. It's become what they call a wedge issue. You can't even have civil conversations about it because it's been so emotionally charged because of the intentional decisions of this company, among others. Okay, this happens to be a public company. There's, the Coke Industries, which is probably much worse, but that's a private company. It's not publicly owned. But this is a public company that it has to respond to its shareholders, and it has been spending a long time on the wrong side of this for its own selfish reasons. Now, the shareholders of ExxonMobil have been pushing on it for many years, saying, we want you to be more transparent about climate change. And a couple of years ago, they wrote a report. It was called Energy and Carbon Managing the Risk. It was a continuation of that campaign of disinformation. This is a graph from that report. Exxon talked about various different scenarios to move to a low-carbon economy. And so you can see here the 450 ppm scenario, 550 ppm, 650 ppm scenarios. These actually came from an MIT study. I don't know if you can read it, but I've highlighted it here. So this graph, at least the left-hand side of this graph, came from an MIT study. And what Exxon said is, governments will never move quickly to a low-carbon economy, and so our assets aren't going to be stranded. And the reason is it's going to be much too expensive to move to a low-carbon economy. So don't worry about the valuation of our assets. You can see what they said. This is from their report. Different levels of CO2 are converted to estimated annual energy costs for an average American family earning the median income. For example, by 2030, in the 450 ppm CO2 stabilization pathway, that's 450 is kind of a relatively low carbon economy, the average American household would face an added CO2 cost of almost $2,350 per year for energy, amounting to 5% of total before tax median income. These costs would need to escalate steeply over time. And you can see up here, Exxon did its own conversion, they called it, of this graph from MIT to the additional CO2 cost for the average American household, showing that by 2090, in a 450 ppm scenario, it would cost 44% of the average American median income. Now, if that sounds incredibly expensive, It is. It's crazy. It's just crazy. It will not cost that. How did they get that number? Well, you can kind of see on this graph. First of all, there's just on the vertical axis, it's just a price of emissions up to $1,000 a ton. Now, $1,000 a ton is a crazy number to begin with because it costs less than that today to pull carbon dioxide out of the atmosphere. So you're never going to have to go that high. You would never charge more for putting carbon dioxide into the atmosphere than it costs to take it out. But now think of what they're doing. They're just assuming that the average American household is going to produce the same amount of emissions when emissions cost $1,000 a ton as when they cost nothing. Okay? Have you heard of a demand curve? Okay. What else did they do? Well, they look at the current amount of emissions times $1,000 a ton, which presumably is going to happen in 2090, and they compare it to today's income. You know, income tends to grow over time, and over 90 years or 75 years, it grows a lot. So that's ridiculous as well. What else did they do? This is like a, test for undergraduate econ students. They looked at the cost as being price times emissions, okay? What happens to that cost? Those are revenues to the government, okay? It's not just the cost. What do you do? They're acting as if you burn that money, okay? It's the net impact that matters. So the bottom line is economists debate about what it's going to cost to move to a low-carbon economy. And the debate is maybe it's 1%. That's at the high side. And there are other economists who talk about a double dividend, that you're actually going to stimulate the economy by pricing emissions and incentivizing the move to sustainable energy. I happen to be in the latter camp. I think if we use the revenues from a carbon tax to pay for comprehensive tax reform, which is a big priority of the Trump administration, you would actually stimulate the economy. There would be no net cost, okay? So why does Exxon say it's going to cost 44% of the average American income? And by the way, this report I wrote like 3 years ago was again referenced in their annual shareholder meeting, which was just a couple of weeks ago, May 31st. Once again, the shareholders of ExxonMobil said, we would like you to be more transparent about the impact of moving to a low-carbon economy on your business. And they said, we oppose this shareholder proxy because we think we've already answered the question in this report. It was ridiculous. Now, you may know the attorney generals of Massachusetts and New York are investigating Exxon. One of the things the Attorney General from New York said is, I want to know where that 44% came from. Yeah, it's a good question, because it's just a bunch of lies, okay? And this is a public company. It's fighting back hard, okay? But the shareholders, by the way, this year, 63% voted against management. It's unheard of for the majority of shareholders to vote against management. So again, I'm just saying this is an important role of investors, of asset owners, is to represent, to require good governance. And so despite what you might read in the papers, we're getting very close in the US to the institution of a carbon tax. In fact, I just read when I landed this morning that Exxon has joined a group called the Climate Leadership Coalition, which is urging Congress to impose a carbon tax. Okay, so there's a lot of movement in this direction right now. Okay, what about hedging stranded assets? Okay, I define stranded assets as assets whose valuations will be negatively impacted by appropriate pricing of emissions. Okay, and it's sort of coal, obviously. And by the way, coal is pretty much gone. All the major coal companies in the US went bankrupt, have already gone bankrupt. Expensive sources of oil. And expensive sources of oil is the front line. So all of you who think about energy markets, think about expensive sources of oil versus less cheap sources of oil. Saudi Arabia has 80 years worth of oil that's available under the sand for a couple of dollars a barrel. Okay? How much should they produce? You know, they're holding back their production to push up the price of oil. Well, that doesn't make a lot of sense. If you have a reservoir of oil and you don't think you're going to use it all, you should take market share today, not save it for a day when you're not going to need it. You know, they've been thinking that we were going to hit peak oil where we wouldn't have enough oil and the price is going to shoot up. Today, people recognize we're getting very close to peak demand for oil. We're not going to need all that oil. So we don't need oil under the Arctic. We don't need oil from deep under the oceans. We don't need tar sands oil because Saudi Arabia and other, fracking has created inexpensive sources of oil. So in particular, companies that are in the business of extracting oil from expensive sources, and that would be Exxon, Chevron, they're stranded assets. And so when shareholders say, are you a stranded asset or not? And they say, no, we're not stranded because it's going to be very expensive to move to a low carbon economy, they're lying because they don't have an honest answer. Okay? And you're seeing it play out. What they'll tell you is well, at least for the next 15 years, we're going to need oil. And that's true. And they say, well, our reserves are going to be extracted within 15 years. Well, that's also true. But if there's plenty of cheap oil out there, what does that imply for the price of oil? Okay, you may know that there's a glut of oil in the world today. That's a permanent glut. Price of oil is not going up, as many people think. They were saying a year ago, well, the price is going to go up in 2017. Today they're saying, well, the price is going to go up in 2018. This is a cyclical commodity. Well, it's a cyclical commodity that has reached the end of its life. Okay, we're not going to need all that oil. And so it's going to be a tough environment for companies like ExxonMobil. So I just, they are a stranded asset as well as being a player that has been doing a lot of things that I don't approve of. Okay, so as an investor, what does this mean? Well, it means you should avoid having stranded assets in your portfolio. AP7, by the way, just announced a couple of days ago, they're divesting of Exxon and Chevron. I congratulate them for that. It's a smart thing to do. I addressed this as the chairman of the investment committee for the World Wildlife Fund in the U.S. About 4 years ago. And we decided to eliminate coal and tar sands and expensive sources of oil from our portfolio. It's based on analysis like this. This comes from a group called Carbon Tracker that's based in London. And they basically say, look, if we move to a low carbon economy, there's going to be, what do they say, over $2 trillion of capital expenditure on projects that are not going to be needed because we're just not going to burn all of that fossil fuel. So you don't want to own the companies that are making those investments. At the WWF, we asked our consultant to help us eliminate those stranded assets from our portfolio. Our consultant, Cambridge, said, you only have 0.5% of your portfolio invested in stranded assets, and it's distributed throughout your managers. You've got stranded assets in your private equity, in your publicly traded equity, in your hedge funds. You're going to have to restructure your entire portfolio. Don't worry about it. And we said, well, we're the World Wildlife Fund. We have to be concerned about it. And so let's come up with a more creative solution. So they came up with something that I really liked. It's a stranded assets total return swap. So we actually didn't touch the underlying portfolio. It didn't cost us anything. What we did is we put an overlay on the portfolio. And we did this swap with Deutsche Bank. People sometimes ask, why would Deutsche Bank take the other side of this? And of course, the answer is they didn't take the other side. It goes into a derivative trading book, and they hedge it. Okay, so, but for very low cost, they said, we will pay you the total return on the S&P 500, and you pay us the total return on a basket of stocks that you can create. And so we created a basket, had coal, tar sands, and expensive sources of oil. And this is how it's done. Now, when we decided to put it on. We actually instituted it at the beginning of 2014. We looked at the history, and it had underperformed by the previous 3 years, 18% annually. Some of my former partners at Goldman said, Bob, you know, now's not the time to be shorting coal. It's very cheap. Well, it was cheap on the way to zero is what it was. And it has continued to underperform. Over the, I've updated the graph that you have in your book. It's now up 82% from the time we put it on. And now you can see it did very well. I don't know if this laser is, but it did very well for the first 2 years up until shortly after the Paris Treaty was signed. It was, in fact, that was the high water mark, was shortly after Paris. Last year it did very poorly. And interestingly, starting this year, right after the election, it's actually started going up again quite a bit. So it's up about 20% this year. I've kind of noted some of the interesting things, but I'll point out the first annotated date there, May 6th, 2014, was when Stanford, my old alma mater, announced it was divesting of coal. I thought that was very nice. They were the first major university to do that. Yale, a few months later, announced they were not divesting from coal, but their CIO, David Swenson, wrote a letter to all of their external managers basically saying, look, climate change is real. It's going to affect the valuation of all assets, and we want you to take it into account. I think that was a very significant signal to the investment industry that they should take it into account. And basically, this stranded asset swap has done very well up until that point, at which point OPEC decided to freeze production. You saw oil prices rebound from a low until just, I think, December 7th or so of last year was this low point, and now it's moving up again. In any case, I would highly recommend that those of you who have stranded assets in your portfolio think about hedging them or entering into something like that stranded asset swap. By the way, before we move on, one of the things I like about the stranded asset swap is it's a very simple bet, if you think about it. This is just a bet that stranded assets are going to underperform the market. To me, that's an obvious bet. I really do believe markets are pretty efficient. And so you have to ask yourself, maybe that's all priced in already. And that is the question. Over any short period of time, who knows? But in the long run, I think it's very unlikely that stranded assets are going to do better than the market as a whole. And so as an investor, it hedges your risk. It provides you potentially a positive expected return, and it aligns your portfolio with the movement toward a low-carbon economy. And finally, as investors, I think there's an important role to engage with companies. We've already talked about the shareholders engaging with ExxonMobil. I also think that investors have an important role to play in the aviation sector. One of the problems that we have, as I mentioned, in terms of a global response to this problem is that we don't have a strong global governance structure in the UN. We do have a strong global governance structure in the aviation industry. It's called ICAO, the International Civil Aviation Organization. And ICAO, 2 years ago, I think it was, agreed finally that they were going to institute an offsetting measure so that post-2021, they will buy offsets for any increase in emissions that are going to be created in the aviation sector. It's a start, let's put it that way. It's not a very good start for a number of reasons, primarily because it doesn't create appropriate incentives for aviation. The offsets they think they'll buy will cost maybe $5 a ton, and they've decided ahead of time that they're going to share the expense. It's kind of like we all went to dinner and said we're going to pay for the total bill on a per capita basis. We don't have any incentive to economize in the dinner. And similarly, the aviation industry has decided that they're going to split the bill for these offsets. And so no individual airline has even the $5 per ton incentive to reduce emissions. For an airline that has a 5% market share, they would have an incentive of reducing their emissions of about 25 cents a ton. So it's not adequate. We need an appropriate incentive. And so I'm working with a group at MIT come up with an appropriate incentive in the aviation industry. One of the nice things about the aviation industry is if you want to participate in international aviation, you're going to have to pay that price. So it will be a global price, and it will be the world's first globally harmonized price, so it's important that we set it at the right level. And with that, I'll be happy to take questions.
Thank you very much. Thank you very much, Mr. Litterman. Ich gucke in die Runde, sehe ich schon ein Handzeichen. An dieser Stelle noch nicht. Dann fangen wir ausnahmsweise mal mit dem iPad an. So the first question was sent to us via iPad. What is your view on nuclear power?
Well, I think when we create appropriate incentives to reduce emissions, then whatever the answer is should be set. I don't think governments should be picking out industries. But having said that, I have no problem with nuclear power. In fact, I'm an advisor to a nuclear energy company. I think nuclear probably will be an important part of the solution in terms of providing a clean, safe load, along with solar and wind and other sources of sustainable power. So I think it's probably a good bet that nuclear will continue. I think we'll probably rely on new technologies, small modular reactors rather than the big reactors that we have. And for those who are concerned about the safety of nuclear, I would agree. Safety is an issue. But I think those issues can be addressed appropriately and economically. I don't think governments should be making those decisions. I think private industry should be making those decisions given appropriate regulation.
Thank you very much. Another question from the audience? Yes? Herr Kovac, kommt zu Ihnen.
Yeah, question, you approach global warming from a risk management point of view. And hence, I would assume that you need to take into account the information content that's in prices. And so my question is, how do you approach this really from a market scientific point of view when the effects of what we're talking might be noticed way down the road, and that the current market prices might not price those effects correctly as of now?
Sure. So let's distinguish two things. One is I totally think we need market solutions, which is to say we need to price emissions appropriately. Now, when I say we need to price emissions, the market doesn't do that for you. There's no way that we can create a market in emissions other than, in the EU, you can create an artificial market by limiting, credits or something. But it has to be a government-imposed tax. This is an externality. We know how to treat externalities. We need a Pigouvian tax. It can be done various ways. You can either have a tax or you can have a cap and trade, but the incentive to reduce emissions, I like the word incentive rather than tax or something else. The incentive can be created a number of different ways, but it needs to be created by governments. And how do we know what the appropriate level is? That's an issue that you raise. Well, we don't know. We can't see into the future. There is tremendous uncertainty, and so we have to err on the side of caution, which means that if in our models where we try and take into account both the costs and the benefits of pricing emissions, there's a whole distribution of potential results, then we have to err on the high end of that distribution. We basically have to say, how high is the price such that the experts are very confident that we're going to solve this problem? And I would say that's, over $100 a ton. Maybe it's 100 euros a ton, something like that. But I'm not the expert, and I would rather rely on experts. So I would like to have economists and scientists working together to come up with a globally agreed upon price. Now, how do you get that done? I think you get that done in aviation. Aviation has, think about it this way, aviation needs the capacity to emit carbon dioxide into the atmosphere. There's no cost-effective solution for aviation. And they've been trying since day one to reduce their fuel. So they need that capacity. There's this reservoir out there, the atmosphere. They know they need it. It's being wasted. So aviation has every incentive globally to lead the effort to set an appropriate emissions price. So I think they will realize that soon, and they will do it. Like I said, I'm working with some folks at MIT to help come up with a global pricing mechanism in aviation that sets an appropriate price, and it's going to be a high price. And once that's done, I think we then have to move to each individual country and create a consensus within all those countries around the world. I don't think it's going to be that hard to price emissions at that high level. I think that's coming within a few years. And as investors, I think you have to be prepared for that. It's going to be a phase change in the economy. You don't want to have those stranded assets in your portfolio.
Okay, ich schaue nochmal in die Runde. Vorne.
Freddie Lutz from BPI. What do you think of Mr. Trump's climate policy?
Well, Mr. Trump is he's a puppet of the of Russia, okay? And Russia is, run by oil oligarchs that have expensive oil. So he has been convinced by the fossil fuel industry that they should fight, that I don't know what he believes, if he believes anything, but that they should undo the climate policies of the Obama administration. Now, let's be honest in this room, the policies of the Obama administration were very, very weak. What was called the Clean Power Plan was going to accomplish virtually nothing. The U.S. reduction in fossil fuel emissions came about because natural gas is much cheaper to burn than coal. And so coal-fired power plants in the U.S. are being phased out. That was happening anyway, and that will continue to happen. The Trump administration, for reasons of politics, that has been horribly poisoned by the fossil fuel industry over the last several decades, has made a big deal about saving coal jobs. You know how many coal jobs there are in the U.S.? Like 50,000. And it's been declining by 30% a year because the coal that is being mined in the U.S. is moving out of Appalachia, where it's uses more labor, to the western states, where it's very mechanized. So those coal jobs are gone. They're going to continue to go. As I mentioned, the coal companies have all gone out of business. So, you can't listen to what's being said. The truth of the matter is, I think we're very close to getting a carbon tax in the U.S. It's going to require Republicans. I'm working with a number of groups that are trying to organize Republicans to support a carbon tax. It's very difficult because there's a lot of what is called dark money in the U.S. The Koch brothers and the fossil fuel industries have organized a lot of money to attack anyone, particularly Republicans, who say that there's a problem, who admit that climate change is real. So when you go around Congress in the U.S. and you talk to people, I've talked to, dozens of representatives and senators, they'll all tell you, I haven't met one yet who is in real denial. They all know it's real. They all know that the appropriate solution is to price carbon. And they say, but Bob, don't ask me to say anything. They're afraid. They're afraid of being attacked by the dark money. Okay, it's a horrible situation. It's just sick.
Thank you very much. So one last question sent to us from via iPad. Do you think the ESG standard will at some point be aided by a risk management framework?
The ESG standard. Well, you know, environmental, social, and governance, to me, those are three distinct things. Within the environmental side, I think that, you know, what we've been talking about is very important. We're going to price emissions. It's going to create a change in the economy, and many valuations, I think, of many companies will be affected by that. I don't think it's built in yet. Now, you know, I'm kind of an equilibrium guy, so I think information does generally get represented in prices. But I think in the case of climate change, people have been waiting so long. Maybe that's not true in Europe, but in the US, you talk to people and they just think, oh, this is never going to happen. You know, that's the way people used to think about gay marriage in the US. It's never going to happen, and then it happened. And I'm telling you, that's how it's going to be with carbon, because everyone knows we have to do this. And they're afraid to speak out, but you're going to get some sort of coalition at some point, and I think it'll probably be soon, and then it'll happen. And so the transition will be very quick. It's not going to be a low price. It's not going to be an ease on the brakes scenario. That's what everyone thinks. It's going to be an ease on the brakes scenario. It's not. When we recognize the reality of what is facing us, it's going to be a slam on the brakes scenario. And so I think that has not yet been built into prices of assets. And so I think investors should be prepared for that. And now, what does that mean? It's very clear what it means for stranded assets, for those who are in the business of making money from exploiting fossil fuels. It's less clear what it means for most companies. If you think about what percentage of the economy is going to be affected by pricing emissions, it's not that large of a percentage, but there are certain sectors that will be very negatively impacted. And then on the positive side, is it going to mean solar and wind and nuclear are going to do well? I think it's much harder to judge which of those sustainable energy sources is going to do well. Someone asked about nuclear before. Well, it may be a winner, but it may not be. There's a lot of other things that will determine which technology in the end turns out to be profitable when we make that move. In terms of more generally these, I think that the factors that companies have looked at, so there's a lot of companies that have come up with ESG factors and then looked at are they going to improve portfolios? I think it's very possible that that's the case, but I think the one that is most obvious is stranded assets are going to underperform. So if I had to say where is ESG going to be most effective, it's going to be in that sector, which is to say fossil fuels.
Thank you very much. I have so many questions for you, so I'll try to wrap them up into two questions now. The WWF, how do you treat government bonds from oil-producing countries?
Well, in the U.S., we've done nothing. I'm not sure we own any government bonds from oil-producing countries in our portfolio. What we did is we did the stranded asset swap. You know, WWF has chapters in countries around the world, and each of those chapters manages its own assets independently. So I can't speak for the whole global WWF portfolio.
So you have not addressed that issue yet?
We did not address that issue.
Okay, so and then the very last question.
But by the way, as an investor, I don't have any particular problem with countries that are producers of fossil fuels, okay? It's governments that aren't pricing it, you know, that's the issue. Once we price it, then, you know, I don't care if people produce it. It's not, to me, it's not a moral issue. It's an economic issue. And the problem is we're not pricing emissions. We have this externality, this risk that's not being priced. We price it, then I'll buy bonds from anyone.
So the very last question, what do you think will be the role of the US government in the future when it comes to climate policy or the fight against climate change?
Well, I think the US can be a leader at some point. You know, what I tell my friends is Trump is like a grenade that was thrown into the Republican Party by the Russians. And we needed that. We needed that. The Republican Party in the US, I hate to say it, but it's just, you know, it was controlled by the Kochs and the fossil fuel interests. And it's very sad, but I think this is the, you know, the end game of that industry that's trying to protect itself, and it's almost over.
All right. Thank you very much, Mr. Litterman. It was a pleasure.